Today we are talking about different types of loans available in India. Number 1, secure loans. Secure loans are those loans are provided against security. The borrowers need to furnish security for available of secure loans. In the case of secure loans, lenders face to lower risk of default by the borrower. In the case of borrower is unable to repay the loan, then the lender can sell the asset to recover its dues. This is the main reason why secure loans carry a lower interest rate than unsecured loans. Let's talking about unsecured loans. These are the exact opposite of secure loans. Unsecured loans are provided against the income or the prospective income earning capacity of their borrower. Regarding unsecured loans, the borrowers are not required to furnish any security. The lenders extend unsecured loans based on the documents provided by the borrower, their income potential, and their civil history. Unsecured loans increase the risk of the lender because, in the case of default by the borrower, there is no security available with the lender from which it can recover its dues. This is why lending institutions charge a higher interest rate for unsecured loans. Types of secure loans. Let's talking about the home loans. Home loans, these are the most common types of secure loans available by the borrowers. As the name suggests, home loans are taken for the purpose or construction of a home by the borrower. Here, the home itself acts as a security for the lender. However, while the income is the primary security, the lender may require a borrower or furnish collateral security as well, depending upon the borrower's profile and the valuation of the home. This can either be a fixed deposit or any other asset. Home loans are long-term loans, and the loans tenure can charge from 10 years to as long as 25 years, as they are usually high-ticket loans running into lakhs and also the most affordable ones. The home loan interest rates are start anywhere between 7% per annum to 7.5%. The loan needs to be the loans need to be repaid in equated monthly installment. The loans to value ratio is usually 80%. It means the borrower can avail of a loan up to 80% of the property value. Moving to the next part, gold loans. Gold loans are taken against the gold owned by the borrowers. Here, gold loans act as a security of the lender, whereby the borrower can pledge the gold with the lender and the avail of money from them. The lender retains possession of the gold until the loan is repaid. The gold loan interest rate starts from 7.50% per annum. Here, most lenders require the borrowers to pay only the interest on the loan amount each month. The principal can be repaid by the borrowers anytime, and they can take back the possession of the gold. Till the principal is repaid, interest needs to be paid each month on the outstanding principal. Further, the LTV on the gold loans can up to be 90%. Next one is vehicle loans. These are the loans taken for the purpose of the vehicle. Vehicles can include both the passenger and commercial vehicles, as they has two-wheelers or four-wheelers and heavier vehicles. Here, the vehicles act as a primary security of the lender. In the event of non-repayment, the lender can seize the vehicle. The interest rate on vehicles loans can start anywhere between 7% per annum to 7.5%. The LTV depends upon the types of vehicle. For certain vehicle loans, the lender can even offer a loan up to 100% of the vehicle's value. Next one is loan against property. Most important. This is a kind of mortgage loan wherever the borrowers can avail of the funds by the mortgaging their property with the lender. Loan against property can be availed of against both residential and commercial property. The administration's charges for loans against property are higher than for home loans. The funds can be used by the lender for their either a business or a personal purpose. LTV is case of a loan against property can be anywhere between 65% to 70%. Further, the interest rates on the loans against the property are so slightly higher as compared to those on the home loans. The interest rate here starts from 8% per annum. Loan. Next one is loan against securities. Investors often invest in shares and securities. This can include shares, mutual funds, bonds, and debentures. The investors are eligible to borrow money from banks and financial institutions against these securities. However, as the securities are volatile in nature, LTV for loans against securities is 50% of the security value. This is the protect the lender against any downside risk due to a fall in the value of the security. Further, the interest rate in the case of loan against securities also varies depend upon the types of security. It can start anywhere between 7.50% per annum. Loan against fixed deposit. Here, banks and financial institutions provide loans to borrowers against fixed deposit. The fixed deposit acts as a primary security for the lender. Further, as the fixed deposit is equivalent to the money banks to the face any risk in the case of loan against FD. Borrowers can avail of the against FD and for amount up to 60 to 75% of the FD value. In the terms of interest rates, while some banks charge a flat interest rate, other banks may charge interest that is 1% to 2% rate higher than the FD rate. Currently, the FD rate is anywhere between 5 to 7.5% per annum depending upon the amount and the tenure. Thus, it can be said that the loans against FD are one of the most affordable security loans. Loan against insurance. Loan against insurance are also one of the popular secured loans in India. Many people have life insurance policies, but seldom to them known that policies can act as a security against which money can be borrowed. To avail of a loan against an insurance policy, the policy must have surrender value. The LTV in the case of loan against insurance is anywhere between 85% to 90% per annum. The interest rate in the case can start anywhere between 10% per annum to 12% per annum. Now talking about the types of unsecured loans. Number one is the personal loans. These are one of the most sought after bank loans in India. Personal loans are loans extended by the banks or financial institution without any collateral security. It is essentially a loan against the income of the borrower. The key features of personal loans are that it does not require the collateral security and there is no restriction as to the end use of the borrowed funds. The borrower can utilize the amount borrowed for the purpose it may medical emergencies, marriage, education of the children, purchasing any asset or traveling. The rates of interest on the personal loan can be range anywhere from 8% per annum to 10% per annum. Short-term business loans. These bank loans are structured to help business meet short-term uncertainties and financial crises. The eligibility criteria are simple, and the amount of the loan that can be disturbed depends upon the profitability of the business and the profile of borrower. The interest rates for the short-term business loans can be anywhere between 1% to 1.5% per annum. Educational loan. That's also one of the most important loans. The most of education is rising at a rapid pace. If one wants to pursue quality education, then he or she needs to shell out lakhs of rupees. In such case, an education loan provides monetary assistance. The interest rate on the education loans can start from 8 to 85% per annum. The amount of the loan depends upon the cost of education. The repayment of the education loans usually begins 12 months after completion of the education. Credit card. Bank. Many of banks offer credit cards. There are great tools to one of gets to spend using the credit card without actual cash outflow. The grace period provides for the time for the repayment to the credit card holder. However, the credit cards are unsecured in the nature. Further, they come with option to convert the outstanding balance to a loan if the credit card holder requires it. This becomes an unsecured loan for the borrower. One of the major drawbacks of the credit card is that it attracts a very high interest rate. The credit card interest can be anywhere between 18% to 36% per annum. Further, and like other loan credit cards, also have a great impact on the CIBIL score. Most important. So that's all about the loans. In the upcoming videos, we are talking about insurance. So take care and goodbye.